Imagine you walk into Costco looking for a gallon of milk, and somehow there's a giant 50% off sign hanging over the entire electronics section. You're standing there thinking, wait, did TVs suddenly become bad overnight? Did PlayStations forget how to play games? Nope, people just panicked. Well, that's basically what's happening in the stock market right now. The semiconductor sector, the companies building the brains behind AI, has taken a serious beating lately. The semiconductor index officially slipped into bear market territory, falling more than 20% from its recent high. And at one point, it dropped nearly 6% in a single trading session. Now, normally, when Wall Street starts panicking, headlines sound like the world is ending. AI bubble burst. Sell everything. Your neighbor's dog predicts a recession. Financial news can be more dramatic than reality TV. But here's the funny thing. Market sell-offs don't only punish the overpriced companies. They drag down the great businesses too. And that's where smart investors start paying attention. Think about it. If somebody accidentally marked a brand new Ford F-150 with the price of a used lawnmower, would you run away? No. You'd probably sprint toward the checkout before someone fixed the mistake. That's exactly why today's pullback has my attention. Now sure, some AI stocks have already made investors ridiculously rich. Take Micron, for example. Someone who invested $10,000 just a year ago would have seen that investment grow to roughly $85,000, even after the recent decline. That's an incredible run, but it's also why many investors feel like they've already missed the train. Nobody likes buying something after it's already gone vertical. It feels like showing up to a barbecue after everyone's finished eating. So instead of chasing the biggest winners, today we're looking at companies that are still building the AI revolution. Businesses where growth is just getting started, future revenue is already lined up, and many still look surprisingly inexpensive compared to their long-term potential. Now, quick disclaimer before YouTube's comment section turns into a courtroom. I'm not your financial advisor. Nothing in this video is financial advice. This is purely for education and research. Always do your own homework before investing. So now that we've talked about why this market pullback could actually create opportunities, let's meet the companies doing the dirty work. And trust me, these aren't the flashy businesses getting all the headlines. They're more like the construction crews behind a massive stadium. Nobody cheers for the guy pouring concrete until they realize the game literally can't happen without him. First up is Sterling Infrastructure. Now here's something most people never think about. When companies like Microsoft, Amazon, or OpenAI decide to build a brand new AI data center, they don't magically appear overnight. Someone has to flatten hundreds of acres of land, move millions of cubic yards of dirt, install underground utilities, and prepare the entire site before the first server even arrives. That's Sterling's specialty. Instead of hiring 5 different contractors and praying they all show up on time, which, let's be honest, never happens, Sterling handles nearly the entire site preparation under one roof. For giant tech companies, every day a data center is delayed costs millions of dollars. Paying a little extra for speed suddenly becomes a bargain, and the numbers are backing that up. Not long ago, Sterling was mostly known as a low-margin road construction company. Today, data center projects account for roughly 70% of its revenue, and that business segment recently grew an incredible 174% year-over-year. Operating margins have nearly doubled, earnings have exploded over the last couple of years, and management expects another major jump ahead. Even more impressive? The company has over $5 billion worth of projects already under contract, giving it years of work already locked in before new deals even arrive. Now let's switch gears to a company everyone knows. Oracle? Yeah, the same Oracle your uncle still thinks only sells boring business software. Plot twist. Oracle has quietly become one of AI's biggest infrastructure providers. Instead of building ChatGPT, Oracle rents out the massive computing power needed to train AI models. Think of it like this. If AI companies need a gigantic warehouse full of GPUs, Oracle is basically saying, "We've got the building, just bring your algorithms." One reason customers like Oracle is because it isn't competing against them. Unlike Amazon or Google, who also build their own AI products, Oracle positions itself as a neutral cloud provider. That neutrality has become surprisingly valuable. Now here's why investors got nervous. Oracle has been spending money like someone walked into Costco without a shopping list. Its capital spending exploded over the last few years as it raced to build new AI data centers. Free cash flow temporarily swung deep into negative territory. And Wall Street absolutely hates seeing that. But here's the part many people missed. Those new facilities aren't being built on hope. They're being built because customers have already signed massive long-term contracts. Oracle's backlog has exploded to hundreds of billions of dollars, nearly 10 times what the company generated in annual revenue, giving management strong visibility into future growth as those projects come online. Imagine you just bought the world's fastest sports car. Looks amazing, sounds incredible, 0 to 60 in 3 seconds. There's only one tiny problem: it doesn't have a radiator. Congratulations! You now own the world's most expensive campfire. That's exactly how AI servers work. The chips might be insanely powerful, but without proper cooling, they'd overheat faster than a laptop running 97 Chrome tabs. And that's where Modine enters the picture. Years ago, regular data center racks used around 5 to 15 kilowatts of power. Air cooling was perfectly fine. But today's AI servers? Some consume anywhere from 50 to well over 130 kilowatts, creating so much heat that the industry is rapidly shifting toward liquid cooling systems. Instead of selling just one component, Modine provides the complete cooling solution, from chillers to coolant distribution units and control systems. That's one reason major hyperscalers are already reserving production capacity years in advance, with one customer committing over $4 billion in future cooling equipment purchases. It's no surprise the company's data center business has been growing rapidly and is becoming a much larger part of its overall revenue. Now, let's move to another name that's impossible to ignore: Broadcom. Here's a fun way to think about it. Imagine Nvidia is the most popular pizza restaurant in town. Everybody wants their pizza. But eventually, someone says, "You know what? Maybe we should build our own kitchen." That's where Broadcom comes in. Instead of forcing companies to buy the same AI chips as everyone else, Broadcom helps massive tech companies design custom AI processors built specifically for their own needs. Google, Meta, OpenAI, Anthropic. If they want something unique instead of renting Nvidia's technology forever, Broadcom is one of the companies helping make that happen. And here's the crazy part: its AI-related business has been exploding, with tens of billions of dollars already sitting in booked AI orders. While the stock may appear expensive using traditional valuation metrics, much of that comes from accounting adjustments tied to previous acquisitions. Looking ahead, its valuation appears much more reasonable relative to the pace of earnings growth. Now let's talk about a company almost nobody outside the tech world has heard of: Lumentum. Picture a massive AI data center, thousands of servers, millions of calculations, constant communication. How does all that information travel? Light, not Wi-Fi, not magic. Tiny laser components. Lumentum manufactures critical laser chips used inside high-speed optical transceivers that move enormous amounts of data between AI servers. And because demand for these ultra-fast optical connections keeps growing, Lumentum has become one of the few suppliers capable of producing next-generation laser technology at scale. Revenue has surged, profitability has improved dramatically, and perhaps the biggest vote of confidence came when Nvidia invested billions into the company, signaling just how important its technology could become for future AI infrastructure. If you've made it this far, congratulations! You're officially learning more about AI investing than the average person whose investment strategy is, "My barber said this stock is gonna moon. Let's finish strong." Next up is Credo Technology. Now, this company makes something that sounds unbelievably boring: cables. Yep, cables. But before you click away thinking, "Really? We're excited about wires now?" Hear me out. AI data centers move insane amounts of information every second. At those speeds, ordinary copper cables start losing signal over longer distances. Optical fiber solves the problem, but it's expensive. Credo found a clever middle ground by creating active electrical cables with tiny signal processing chips built directly into the connectors. These cables can carry high-speed data farther while using less power and costing significantly less than optical alternatives. In AI clusters, even one unreliable connection can delay expensive training workloads, making dependable networking incredibly valuable. Credo currently dominates this niche, holding roughly 88% of the market, while revenue has more than tripled and profitability has improved dramatically. Now let's talk storage, because AI isn't just about thinking fast, it also needs somewhere to remember everything. That's where SanDisk comes in. Most people know SanDisk from those little memory cards sitting in a drawer somewhere next to 3 mystery charging cables you'll probably never use again. But the company's AI ambitions go much deeper. Traditional high-bandwidth memory is incredibly fast, but expensive and limited in capacity. SanDisk is helping develop an alternative called high-bandwidth flash, HBF, designed to deliver much larger storage capacity while remaining competitive on cost. If widely adopted, this technology could dramatically expand the company's addressable market. Since becoming an independent company again, SanDisk has posted explosive revenue growth, eliminated its debt, and even authorized a massive share buyback program. Despite that progress, the stock still trades at relatively modest earnings multiples compared with many AI names. Another fascinating company is Tower Semiconductor. Think of Tower as the manufacturing specialist. It doesn't design AI chips. Instead, it builds highly specialized semiconductor components for companies that do. One of its biggest opportunities is silicon photonics, technology that converts electrical signals into light so data can move incredibly fast between AI systems. Tower is one of only a handful of manufacturers producing these components at meaningful scale, and customers have already committed significant future orders with upfront payments to reserve manufacturing capacity. Then there's Cohu, a company most investors have never heard of. Before any AI chip reaches a customer, it has to survive intense testing. Cohu builds the equipment that checks chips under extreme temperatures, making sure they actually work before shipping out. AI currently represents only a small portion of its business, but orders are recovering quickly, and management sees a growing pipeline of AI-related testing opportunities that could support future growth. Finally, we have Innodata. If AI models are students, Innodata creates the textbooks and the final exams. The company provides expertly labeled data used to train and evaluate AI systems, already working with 5 of the 7 largest technology companies. Revenue has nearly tripled in just 2 years, profitability has turned positive, and demand for AI agents could make high-quality training data even more valuable over time. Previous regulatory allegations were ultimately closed without action, removing a major cloud that had once hung over the company. So, what's the big takeaway? Here's what I find interesting. Everyone is obsessed with buying the companies making the AI headlines, but sometimes the biggest winners are the businesses quietly selling the picks, shovels, cooling systems, cables, lasers, testing equipment, and infrastructure that make the entire AI boom possible. As always, this isn't financial advice. It's simply a starting point for your own research. If one thing is certain, it's this: the AI revolution is still being built, and some of the companies doing the heavy lifting are still flying under Wall Street's radar. If you enjoyed this breakdown, don't forget to hit that like button, subscribe for more deep dive investing content, and let me know in the comments which of these companies deserves a spot on your watch list. Until next time, happy investing and thanks for watching.